All right. Welcome everybody to the Living Hope Agency call. I couldn't be more excited to get our special guest, Mr. Dan Chernati, here on the call. Dan is somebody who I've really looked up to for a long time in this business because he has really shown what it can look like to actually live a balanced life in this business and go out there and have fun selling insurance. And, he's got a really awesome team that have focused a lot on the IUL side of the business. So I couldn't be more excited to have him on here. If you guys don't follow Dan on Instagram, definitely go ahead and do that. You'll see videos and pictures of him traveling all over the world. I've seen this kid selling insurance in Panama and Costa Rica and all across South America. And he's also one of the first people that I saw really be an early adopter on the trend of getting on social media and talking about IULs. You guys see so many people doing the self-generation of leads. He was doing it before it was cool. So I'm excited to have him on here because obviously he saw something that a lot of other people didn't see before it became a big trend. So I'm excited to have him on here. But Dan, how we doing, man? I caught you in the middle of a drink. I apologize.
Bad timing. I appreciate the intro,
Yeah, so
Jamie. Sorry. Oh man, that was a weird timing.
no
But
problem.
yeah,
I'll let you catch your breath here. I'll let you catch your breath here for a second. Dan and I recently we started
we're all
all together, so we're having a lot of fun. He just moved back here to Greenville, where we're at. So if you guys ever come out to a lock-in here in Greenville and he is in town, you'll get a chance to meet him in person. But Dan, I'm excited to have you on, man.
appreciate it, dude. It's been a fun journey for sure, and I'm excited to be back in Greenville too. So if any of you guys do come down, let me know. And my apartment's like 4 blocks from the office.
I love it, man. So tell us a little bit about your story, man. How long you've been here, how you got started in insurance, maybe what you did before, and maybe even just a little bit about how FFL looked when you first got started versus what it looks like now.
Dude, everything about life is totally different. FFL, personal stuff, it's like life totally different. But it's been a great vehicle to make that change. It's all good, very good, different. But started out, I did the whole go to school, get a good job, go up the corporate ladder. I signed up for my corporate job there. You get to travel. So I lived in Australia, the Middle East for a little bit. So a bunch of fun stuff. Then there was a time in Charleston, South Carolina. I remember it vividly. My boss goes to me, "Hey, you work really hard for the next 10, 15 years and you can get to where I'm at." And I'm like, what the F? Like, how long is that? And like, don't get me wrong, it could be like amazing for some folks. I'm like, there's not a shot in hell I'm going to be working the next 10, 15 years grinding for someone else. So I started looking for any entry level sales jobs, stumbled across a bunch of like FFL ZipRecruiter stuff. And I just kept seeing it everywhere. So I'm like, all right, well, there's a bunch of people doing it. There's got to be a system in place. I'm going to sign up and I'm going to give it a shot. Like, what's the worst case? I fall flat on my butt and like, okay, I go get another job. So all right, let's take that risk. And so that was September 2019, and I went full time in December 2020. Going balls to the wall. I started here actually in Greenville. Just, I put like 70, 80,000 miles on my car every year for a couple of years, run like 40, 50 appointments. The way every appointment would be like 2 hours away from my house, but I always loved driving in the country. But then it got to a spot where I'm all about like sacrifice. Short-term sacrifice is long-term gain. It is a fine line though on how much we can sacrifice for how long. And I was getting to a point where I'm like, hey, I love traveling. I love being able to pick up and go where I want to go. And I want to create a business out of this. And if I want to create a business out of I can't be driving around 100 hours a week for much more time. So Juan Franco got me into the IUL space. I got myself a one-way ticket to Colombia down in Medellin. I was like, all right, I got to figure out this virtual stuff. It wasn't going that well. I got into the IUL space. I want Franco. Said, hey, I got all these hot leads coming in, and we were running like so many like Instagram, TikTok, like recruiting stuff. And I was like, dude, where are these leads coming from? He goes, my social media. So I'm like, no shit. So my recruiter at the time had completely changed focus. Hey, John, from here on out, nothing about recruiting. We're only making stuff for IULs. That was about a year and a half ago, and now we're doing pretty well. I got to a spot, Jamie, like the organic slowed down. So I love organic leads. They're amazing. I still run a couple of them, but the scalability of it, we found out it's hard. It's very unpredictable, right? You could have a lot come in one month, not a lot another month. So it was waves that would come. So then we started doing different Facebook ads, figuring that side out. And we got to a spot last year. I think there were a couple months, we we're doing like 700,000, $800,000 with 30 writers. Out of those 30 writers, like maybe 10, 15 of them were full-time. So they just got the process down in the IUL space, and now, I mean, it's all virtual now for whatever we do, final expense, mortgage protection. But it's been a lot of fun. For me, I always look at money like it's like a game of Monopoly. Remember when I got my first paycheck? I go to my uncle Tom, who's like always helped me on the finance stuff. I'm like, Tom, I just made a boatload of money. And I remember going like line by line down. I was like, where the F did all that money go? And he just goes to me, Dan, you're going to spend the rest of your life trying to figure out how not to pay that. He was self-employed, so he's also figuring out all the tips and tricks, and stumbled on the IUL. Like, I love real estate and I love IULs because IULs are tax-free. So just the way the cookie crumbled was awesome, being able to actually help people now with building wealth.
Absolutely. That's something you and I have chatted about a little bit. So for you, you are helping people learn how they can obviously, sell IULs to create cash flow, but then you're really going above and beyond with your agents and showing them, hey, once you do make some money, yeah, I'm going to show you how to invest it back into your insurance business, but also I'm going to teach you how to invest it into real estate and how to really create wealth.
100%. Yep. And that's how I look at it. Like, in order to, we can grind for so long, right? There's got to be like a next step. Like, what's next? What comes next in our chapter? Whether it's building an agency, whether it's doing other investments. We got two ways to retire in insurance. You either sell a boatload of insurance and you invest it elsewhere, right? You get into real estate, you learn a different skill. We got to sell a boatload. Option number two, you get really good at building an agency. So at my agency, we have two different routes you can go, or you're going to be doing this for the rest of your life. So either we're gonna get really good at selling and learning how to do other stuff, putting in some more passive income, using our active income to create passive income, or we're gonna build an agency. Which one do we want to tackle? And sometimes people say one thing and then go to another, and vice versa. It's building an agency ain't easy for anyone on here that's building an agency, right? It's ups and downs, putting out this fire, that fire. How do you deal with this person, that person? And I have all this debt. So sometimes we say different, but then experience that, hey, you know what? I'm going to sell a bunch. Hey, I do want to build an agency. But yes.
I love it, man. We'll come back to that thought here a little bit, but let's just come back to just your intro to IUL. So like, you were selling final expense, you were selling mortgage protection, and then you discovered indexed universal life. Like, what was it for you where it kind of made the light bulb go off? Was it the concept of the product? Was it, you said, that's something that I would actually buy and something that I would feel comfortable, showing to my friends and family? And I know this is really going to transition us to the next question I have about how to structure these properly, but talk to me about just that light bulb moment for you and kind of why you wanted to shift all your focus over there.
So I like working with people that got some money lying around. I think it's fun. I think there's some more strategies involved that we can do. So the IUL is like, someone wants to ask me like, what I sell. I go, IUL. Dan, you don't sell an IUL, you sell a financial solution. The same thing with final expense and mortgage. On the IUL space, how we structure them, to anyone that's listening, we structure them a little bit different than normal life insurance is viewed upon. And I never even knew what I always thought whole life was just what we offered. I didn't know that there was anything outside of whole life other than like a living promise. I had no idea. And then you start hearing about the infinite banking stuff with Nelson Nash or Doug Andrews with he's got the laser fund out there, or David McKnight. You start hearing about all these different ways you can use insurance. Like, wow, this is actually really cool. You're able to provide a financial solution for someone, help someone build wealth, and in a tax-free environment. And Jimmy, you hit the nail on the head. Like, I would buy it myself. I do have one myself. And I think it's a very, very cool way to help build wealth. And some agents structure as like the end all be all, or it's going to be amazing at 10, 20%. It ain't going to do that. If you look at banks over here, you look at stocks over here, banks nice and secure, you ain't getting any money in there. Stocks more risky, higher growth. And IUL is not designed to beat the market. It's right in between those two. So for me, it's more of a safety and tax-free. And there's also a couple of carriers that you have it lifetime income, which can be very, very important. There's a study, it's actually turned into a movie. It's called the Baby Boomer Dilemma, where most baby boomers are worried about outliving their retirement funds. And people that have something like a guaranteed income for life IUL or a fixed index annuity or a multi-year, whatever type of annuity it is, their quality of life and life expectancy is a lot higher because they're not actually stressing about where's this money going to come from for X, Y, and Z. Even if it might be a little bit less money, but it's guaranteed, they have the stability in their life, know that they're never going to outlive their funds. I'm like, wow, that is really freaking cool. I'm going to do that.
So give us like a basic breakdown. If someone were to just say, "Hey Dan, like I kind of understand what an IUL is, but like what are like, two or three points that when you're setting the table with someone on an appointment who kind of knows what it is just from an ad, but doesn't really know what it is, and break down IUL for like a kindergartner for us."
Cool. So if I were to break it down like a kindergartner, what would I say? So huh,
Maybe like a middle schooler.
it's funny that you say that because one of my agents literally asked me to do the same thing for her, saying, "Hey, I need like just like a quick Spark Notes version to dumb it down." Someone said genius is hidden in simplicity. So the simpler we can make it, the more genius it actually is. Especially if you look like stuff like Uber, it's like it's so simple. Like Uber, well, it's so simple, but it changes the world. Stuff's so simple. Um, for an IUL side of things, it's a way to build wealth through life insurance and a tax-free environment. So similar to a Roth IRA, not investment. We can never call it an investment, but similar in the sense that when we go to take our money out, we're not going to pay taxes on it. So you'll participate in the market upside, but not in the market downside. So when the markets go up, we'll see gains in the account. When the markets tank, we just have our cost of insurance in place. So if the cost of insurance was $1,000 that year, we paid $1,000. Now we have the gain.
Hmm, that's good. So there's obviously a couple different ways that you can structure an IUL. There's like a protection focused, and then a lot of your content that I see on social media is all about, minimum death benefit, maximum cash growth, and then of course, unique situations depending on what somebody's looking for. Maybe it's something in the middle. Like in what situation would you structure something on like an easy solve, max protection versus a maximum accumulation?
So just asking a client what their goal is. So, hey, are we more focused on the death benefit? Or are we more focused on the cash value? Are we not the cash value? I'm going to say more focused on the retirement side, death benefit or retirement, because we can't have both inside of an IUL. It'll look like there's both, and it can be pitched like there's both. We don't actually have both, and there's a couple of nuances in there where if we kind of set it up to have a lot of both, you can't. It's kind of like a seesaw. And what I explain to all my clients and my agents, let's just imagine, Jamie, you're putting excuse me, $1,000 a month into the IUL. That $1,000 is going to two different places. You have the death benefit and you have the cash value. So if we look at it like a seesaw, if we have a high death benefit, more of that $1,000 is going towards the fees and the death benefit. Less is going to go towards the cash value. So I explain to my clients, you're more focused on the retirement side, right? Correct? Yep, cool. Hey, we're going to drop the death benefit down as low as legally possible so the IRS isn't coming after us. That way the cash value is going to grow the most. So that's how I explain it to everyone. It's just like a seesaw. And
So
yes,
something that's in the middle, let's say. So let's say you've got $1,000 that's going towards, it's going towards the policy, and let's say $500 is going towards insurance, and 500 is going towards cash value. Is that a policy that's going to last, or is that a policy that's going to kind of collapse on itself?
it depends. So you would have to look at it. It very well could collapse. It very well could go forever. A lot of the IULs will illustrate very well, and they'll use like indexes, like some venture capital fund that hasn't been back tested yet. It'll illustrate well, but we don't actually know how the index is going to perform. I like to use a lot of the S&P 500 indexes. But what happens is if the cash value is not actually growing that well, not only is the cash value not growing as well, the expenses in the policy are actually going to get more expensive. So a policy that looks like it might have 100, 2,000, $200,000 in there, once you actually understand how the IUL works, might not actually have it. It'll look like there's money in there, but the policy needs it later on in its life so it doesn't run out. And if we access the money, it could blow up. So whenever I look at it, kind of like keeping it simple. There's two different types of premiums typically in an IUL. You have what's called the annual premium. So let's say someone's putting in $1,000 a month. The annual premium would be $12,000. The other one is called a target premium. That's like pretty much what our commissionable premium is. A big red flag for how I structure IULs. If I'm ever seeing a client that says, hey, I want this for cash value, and I see an IUL like this, for me, I know that's a red flag is when the target premium is anywhere close to the actual premium. The target premium should be a lot lower than the actual premium. Once the target premium starts getting up to the same or higher, that means that the policy is going to be underfunded. It might look like there's cash in there, but again, there's not, because the death benefit went up too much. So it's hard to say if it was like 50-50 like that. You'd have to look at the target premium and the actual premium. And the target premium in a max funded policy should always be a heck of a lot less than the actual premium.
Yeah, and I've heard Zach Tardowski said something a couple of weeks ago where he's like, if you structure the policy to get paid the highest commission, but you pitch it to the client as if they're going to have the maximum cash value, these are the types of clients that actually will call you at the end of the year. And like you can actually get in trouble. So talk to how do you like make sure that like what you're saying expectation wise is something that can line up with what the client under promise over deliver kind of a deal, because even like I'm looking at some of these easy solve IULs that I started with, and I realized that for about a year I've been pitching them incorrectly. Now it was off just a little bit, but I realized that I was saying things like this is guaranteed to last until age 100. But where does it say that? It actually doesn't say that. I heard somebody else say it, so I started saying it, and then therefore a bunch of our agents started saying it. And it's like this is guaranteed, or this should last till age 100 if the market does X, Y, and Z. But if the market doesn't last, doesn't do that, the guarantee is actually right here, and the guarantee is only 25 years. And like I didn't realize that. So like, how are you explaining those types of things to clients?
I get it. I did the same thing for a while until there's a couple of books that I read that I think was one of the other questions on how I got educated on some of this stuff, and I'll talk about it in a second. But it's like, wow, there's a lot more. IULs, they can be very simple. It's not like it's rocket science, but it does piss me off a little bit when there's a lot of people out there making all these heavy claims and they're like big creators or they're just brand new and jacking up death benefits. Yes, you get paid a lot, but these clients will call you later. So I always tell people that, hey, would you put your family in this situation? Is this a policy you would sell your mom, your brother, your sister? Treat these clients like that. So maybe we get paid less up front. And that's okay. If we're always doing the right thing for the client, at the end of the day, you'll get paid a lot more. You're gonna have a lot less stress knowing that, hey, I'm helping this person out. But imagine, dude, someone's putting in $1,000 a month into a policy and they don't know they kind of got screwed over for 15, 20 years. That's a lot of money. So I would never want to put anyone in that situation. But bro, I just lost the train of thought. What was that question?
Just talking about how to make sure proper expectations with the client. So like when you have things like, you know, people saying
Yeah.
things like guaranteed, or when you look at the illustrated rate that says 8.49, but you're like, it's not going to do 8.49. Like, how do you explain that stuff to the client?
Gotcha. So typically what I tell a client is, hey, illustration is just an illustration. In my experience, between 6 to 8-ish%, 5 to 8% would be fair to see on our cash side of things. Could it do more? Sure. Will it have some 0 years? Sure, 100%. But I would not buy this, Jamie, if our intentions were to outperform the stock market. This is not what it's for. The expectations of it, the clients that I work with, the ones that love this, they still want to see growth on the money. They want to have some liquidity to it, but they don't want it to be at risk. They don't want to see that their portfolio just vanish. And Jamie, does that make sense?
Yes.
Yes, 100%. So I like really kind of going into depth then, Jamie. What is it? What's a client's goals? You know, there's different strategies to use with, for example, the increasing death benefit strategy and a level death benefit strategy. There's a big difference between the two. For the longest time, I didn't even know an increasing strategy existed.
So
That's
why would you go one or the other? Because there are, when we're getting through like IUL basics, IUL boot camp and stuff, it just for simplicity purposes, most of those illustrations are done level death benefit. But as I'm starting to, get more educated, if I was going to write myself an IUL, I would want it to be on the increasing death benefit. So how could you explain that to everybody, the difference between the two?
Yes. So my policy as well is also an increasing death benefit policy. There are scenarios where a level can be a lot better. It's funny, I just did this training with my folks today at one. So you have two basic types of death benefits. You have the level death benefit and an increasing death benefit. The biggest difference is how the fee structure is going to work. With an increasing death benefit, or backing up, so both the policies, the cost of insurance is based on an annual renewable term policy. What that means, every single year, the cost of insurance is going to get reevaluated based on how much insurance is needed and your new age. So for an increasing death benefit policy, you do get both the cash value and the death benefit if someone passed away. That's going to be called the net death benefit. On the increasing side of things, let's say you're putting in just say $1,000 a month. Let's just say your death benefit to start was $300,000. Every single year, you, Jamie, have $300,000 of insurance that you're paying on. The death benefit will say like 312,000 because it's going to add up the original 300,000 plus the cash value. And that's what gives you what's called the net death benefit. So every year you're paying on 300,000 bucks of insurance. So actually that's why you see the death benefit rise, because your cash value is rising and it's adding those two together. In year 30, you still have 300,000 bucks of insurance plus whatever that cash value is. With the level death benefit policy, how the cost of insurance works is a little bit different. Instead of having $300,000 of death benefit, Jamie, you're going to start with, let's say, $1 million of life insurance in place. So the fees in that policy are going to be very, very heavy at the beginning, which isn't the worst case scenario. But how the cost of insurance works, it's a lot different. It's now, again, based on what's called a net amount at risk. That's going to be the difference between your cash value and the death benefit, or vice versa, the death benefit and the cash value. So let's say in year one, you have 10,000 bucks in cash value and you have $1 million in death benefit. The difference between those, the 990,000, that's what your cost of insurance is based on. Let's say in year 20, you have $200,000, just that shouldn't be the case, but let's just say, for example wise, you have 200,000 bucks in there in cash and you have $1 million in death benefit. You're now paying insurance on the $800,000. So the cost of insurance is going to go down. What kills an IUL, the very, I say I love IULs. Like I absolutely love them. I think they're an amazing tool. What kills an IUL, the fee-wise in the beginning, is the expenses in the policy. Higher the death benefit, higher the fees early on. Later on in insurance, the life cycle of an insurance policy, it's not the fees that are expensive, it's the cost of insurance. So that's why it's very important if we structure something with an increasing death benefit. I know this is getting fairly technical here, but it's very important to change it to level when the client stops funding it, because you're changing how the fee structure works with the cost of insurance. If we don't make that change, it can be very bad news for the client. A level death benefit policy would be better for someone that does want a little bit higher of a death benefit. Maybe they got some kids or they got some family, and they actually need that death benefit in place. I would never put into place more. If someone still wants it for cash value, I'm not going to add any extra death benefit to a min-death max cash level policy. If they really needed more death benefit on top of that, I'm going to write up a term policy instead. But I don't want to mix the two too much, because what happens is that the interest rates, they're not getting credited what it's illustrated at. And now there's more death benefit, the policy could explode. We don't want that to happen. But an increase, what I explain to my agents, how do we know what's better for someone? And I say, hey, we're going to keep it very simple. And these are for folks putting in, let's say, $1,000 a month or less. With an increasing death benefit policy, there's no wiggle room to put in more money. We can't. If you want to, if you had a client that wants to put in $1,000 a month, but from time to time wanted to dump in $10,000, you cannot do that with an increasing policy. There's a term that's called MEC, Modified Endowment Contract. It's the most that we could put into a policy in a given year without blowing it up. And that's going to pretty much be based on what the original death benefit is. So if the death benefit was just at 300,000, the MEC's going to be a lot lower, maybe something like 13, 14,000. So there's no wiggle room there. With the level death benefit strategy, the MEC, instead of the 13K, let's say, is going to be $40,000. So that's not typically a good thing, because that means there's a lot of more death benefit in place. I kind of explained like a fishbowl. If we want to put in more money, we need a bigger death benefit. But for a client that says, hey, you know what, Dan, I can put in that $1,000 a month, and I'm confident, I'm very confident in the first couple of years, I want somewhere I can put in an extra $5,000, $10,000 a year for the first couple of years. Well, then the level death benefit can handle that money. It's a bigger fishbowl. It's a bigger death benefit. So you can put in more money into that bucket. And what it's doing, it's just going to take the premiums pretty much from later on and put them up front. So you're getting money working for you. So there will be higher fees involved in it. The fees will be a lot higher at the beginning, but if we can get a lot of money in a lot faster, it could actually outperform a level strategy. And I say that with a grain of salt. If someone's putting in $2,000-3,000 a month, they really got to throw some mad money into this thing for that strategy to make sense.
Absolutely. So here's kind of where I want to shift is obviously how people can get educated, but also like, why is it worth getting educated on some of this stuff? Like you and I, we went and had sushi, last week or the week before, and we talked a little bit about this, and we talked about persistency and how the average mortgage protection final expense policy has a 70% persistency. And the average IUL across FFL right now, I think, is 92%, which is crazy. And you and I, we've both, been agency owners for a handful of years. And one of the things that's no secret that happens is when agents quit and they leave behind chargebacks, there's roll-up debt. And you said something to me that just blew my mind. You're like, yeah, I had roll-up debt last year, but almost all of it was from final expense and mortgage protection. And I had less than $1,000 in roll-up from IUL policies from anyone on my team. And that was just like a mind-blowing thing for me to hear, is that, I mean, for the most part, if these are structured correctly, these are policies that stay on the books and nobody's going to be able to come behind you and replace it. So, I guess why is it's a lot to learn all of this, to learn about increasing in level and all these different strategies, but like, because you've learned it, you've kind of given, just like the IUL's designed, where it's like we get to participate in the upside, not the downside. You've created a little safety net for your business too, because you've got agents who are also educated, agents who figured out how they can do the right thing for clients, have high persistency, and they're still in the business too. We talked about, you had 700 families helped in a month by 30 agents. That's pretty wild. That means you have high producing agents, and you've got some of the highest producing IUL agents in the entire company. So I guess 1,000-foot view, like, why is it worth it for people to get the education that you've gotten?
So the barrier to entry to get into life insurance is so low. Anyone can go out there, take a test, and get their life insurance license and get to work. The barrier to entry to become an expert in a field in insurance is very high. A lot of people just go through the ropes. Hey, I'm going to just be on the hamster wheel, and that's what I'm signing up for. To actually get out of that hamster wheel, you got to start thinking like someone that's out of that hamster wheel. You got to become an expert at something. And a reason that I love the IUL space, now my agents, they're all freaking educated, dude. They know how this shit works. They can talk to people. I had this guy, David McKnight, on one of our agency calls about a year ago. And he's one of the guys that I'm going to recommend you guys pick up one of his books. But he came on our call and someone asked, like, hey, Dan, or hey, David, how do you sell more insurance? And he goes, stop effing talking about insurance. No one with money wants to talk to the insurance guy or gal. They want to talk to someone that understands how to use wealth. They want to talk to someone that understands how money works. So the reason I love a lot of what we do in the IUL space, Jamie, it's not just about the IULs. It's about what you're going to learn about how mortgages work, cash out refinances, how interest rates work, how loans work, how valuations of houses work, how markets as a whole work. And by always becoming more and more educated on a lot of that stuff, it's also for you individually, myself individually, it keeps me motivated. It's not the same thing over and over and over again. And yes, we do a lot of the same thing, but there's always a next step. What else can I learn about money? What else can I learn about 401ks, Roth IRAs, rollovers, qualified funds, non-qualified funds? Like, what more can I learn? And that keeps my brain very active. And I believe the more active our brains are, the better that we're going to do. Sometimes we got to turn it off and just get to work, right? So I think we've all gotten our own way by having it too hyperactive, but it's learning the game of money. But I do look at money. It's like a game. It's not going to solve all problems, but it sure as heck makes them a lot easier. And the better financial knowledge that we have, the better we can serve our clients. And on this side of things, it's like my agents, we're about to buy a house together. It's fun. Like, hey, let's go learn how this works. Let's learn how that house works. And now imagine you're about to hop on a call in the IUL space, Jamie. You have a client hopping in. They're in real estate. Oh, cool. I just closed on my second house over here. We're doing a flip on this. Here's how we did this on our cash out refi. It's about building trust in a client. To get someone to give you money, there's got to be trust there. And if you're someone that's using money as a system, you can have a lot more confidence when you're talking to these clients as well. So it's not just good for you personally to go do this stuff. It also helps out your IUL business insanely, because now they're looking at you as, hey, you're not just an IUL guy. You're not just the insurance guy. You're putting your money where your mouth is, and you're employing what you're teaching me right now. And I think that goes a very long way for the business to be in this business a very long time. Like, hey, what's next? And always helping people reach that next level. And then also just from the client standpoint, having the confidence to actually back up what we're talking about.
100%, man. I mean, just from everything that I'm hearing, I mean, when he talks about buying a house with his team, just for clarification, everyone didn't understand that they're going in buying a house together so that they can then flip that house and earn other wealth together outside of insurance. So he's educating people on how to sell IULs, but he's also just educating the team on wealth as a whole. Or he's not doing all the educating. He's pointing them in a direction to seek that education so that they can all grow together. And at the end of the day, you don't necessarily need to have 1,000 insurance agents on your team. You just need to have 20, 30, 40 who want to be a career agent that would rather, that would go to battle with you. I mean, that's really it. So, I mean, at the end of the day, anybody here who's seen some of these huge teams at convention, you go, wow, I don't know if I could ever build a team like that. I don't know if I know enough people. But if you get yourself educated enough on something, this being something worth being educated about, and you start educating one, two, three, four, five agents at a time, you don't need to educate 100 people at a time, but it's like, could you see yourself, we talk about, things being worth building. Lockhart and I always talk about like, this is a 10-year game. It's not a 2-year game. So like 10 years from now, if you had 40 agents on your team who were absolute killers, like they were killers, they're doing 30, 40, 50 a month, and you're making, 10, 20, 30-point spread, like, and it took you 10 years to get there, would it be worth it? Like if you understood how that math worked, absolutely that would be worth it. And then also you've got agents who are doing well that are succeeding. You've got less going out the door that are coming in. And that's been, our hardest thing that we've experienced in the insurance industry is people come in and they go out. You talked about at the beginning, Dan, just this idea of like grind your face off, grind your face off. I'm all about it. I've been doing it for the last 3.5 years, but at a certain point, you have to be able to do something to where you're not going to be selling insurance for the rest of your life. I love selling insurance. I got another 6, 7 years of me minimum before I run out of gas in the tank. But at the end of the day, like I do want to be building something that's worth building. And you and I talked a lot about just balance. You said the other day, you're like, I had that realization, like, would I recruit my own brother? And I was like, that's wild because my mom asked me if she should get her insurance license. And I told her no. And it's like that's kind of like a wild place to be because I love this industry so much. I don't want my mom to do it. But if you get to a point where you're like, I would recruit my own brother, like that's an amazing point. So, I mean, what would you have to say to anybody here who's like really trying to, they're willing to grind their face off, but also like some level of balance and fun is still the desirable goal for them?
So sometimes you got to go slower in order to go longer. Dude, I woke up yesterday. I was like, you know what, Dan, I'm gonna go on a long run. So, Jamie, actually, I ran from downtown here and I ran past TR. And
Wow.
if I was starting to run at like a 7 minute per mile pace, I'd be gassed after like a mile or two. In order to make it the whole length, and it's a pretty much no one here probably knows the distance between it. It's like 10 miles. So I want to go run 10 miles. I had to go a lot slower in order to finish. So my pace was like a 940 mile as a whole. And if I started gassing from the very beginning, I wouldn't have made it to the end. So sometimes you have to go a lot slower in order to actually go further. So I say that there has to be a place that you're going to make some sacrifices somewhere. And no matter what kind of journey you do, you're going to have to sacrifice something. And it's either going to be time, money. What one are we going to sacrifice? Time with the family? Are we going to sacrifice money? What are we going to sacrifice? However, it's very important not to lose focus of our why. And I did that for a couple of years, and I got to the spot where, hey, Dan, I gotta chill out. I'm sacrificing everything I want in life to go make a dime, to go make some more money. And I would do that again for a period of time. There's a book that I read that it's very important for entrepreneurs to understand when is enough enough. And I think there has to be a light at the end of the tunnel that we're all striving for. There's a book that I read. It's called the Almanac of Naval Ravikant by Eric Jorgensen. Very, very solid. And it's pretty much about, when is enough enough? If you're Jamie, an entrepreneur, I say, hey, I got to get to 500,000 bucks. If I could only get to 500,000 bucks, I have everything I need in my life. I have the ability to go travel, to go spend it with my kids, to go wake up late on a Tuesday, go on a walk, do whatever I want. And I'd be so happy if I could just get here. Well, a lot of the problems as entrepreneurs, you now get to this 500K, and now it's just, you just sacrificed a lot to get there. And now you're here. And now it's like, oh, I got to get to $1 million a year. And then you get there. And hey, now it's like I get to $1 million a month. And you keep doing all these sacrifices to get there. And then you get to the end and you realize you just sacrificed everything. You might not have the family anymore. You know, it might not have people to go spend your time with anymore because you just sacrificed the last entirety of those 10 years. So it's very important not to lose focus of where we want to get to as we're on that journey. We can't lose our identity to get there. Our identity will change. You know, obviously, we're going to learn a lot of stuff as you start working your butts off a lot. There has to be a short-term sacrifice, but we just need to be cognizant not to lose what we're working towards in order to get there. So again, in no way am I saying that to anyone, say, hey, don't go to work, just like spend. I am not saying just like don't work. So please don't take it that way. But you know, stay true to what you believe in, why you're doing this. And I used to run a lot, Jamie. It's called a goal-based schedule. I like to think of myself as a very lazy person. I don't like work. I want to go be traveling, go chilling on some beach somewhere. Like I want to just enjoy it. So I built a goal-based schedule. The faster I can get my 30 appointments in, the faster I can screw off the rest of the week. If I can get my 30 appointments in Monday through Wednesday, Thursday through Sunday, I'm chilling. I ain't doing anything work related. So I think that helped kind of change my mindset a lot. Is how fast can I condense time? Can I get the work of 2 days in done in one day? So that way, my Thursday through Sunday, I'm hanging out. Maybe I do some admin work, but I'm walking in the mornings. I'm going on runs. And how fast can I get my work done? And I think a lot of us would be very surprised with our ability to get a lot of work done in a lot faster time if we're very structured with the time that we're working with.
100%. I mean, I'm starting to come to that realization on my own. I mean, anybody who's been with us for a while, I mean, you guys have seen me basically 6 days a week for the last 3.5 years, and I've sacrificed just about everything. And then I noticed when I started it was really hard for me to make any sacrifices in my schedule. I'm very selfish with my schedule. So it was really hard for me to like bill in time for my family and my marriage and all these things. But when I started to do it, I realized it didn't really impact my production at all. It actually started to make me more productive. So it was like Saturdays were like, nothing can ever happen on Saturday. That's it, period. This is where I do most of my production. And then last year we implemented every Saturday morning from like 8 to 1. My wife and I go out for coffee and we get a babysitter. And like that was a thing. And like it was really hard for me to give that up. But then like I noticed that like the production started coming in other places because then I was like more, it's like, hey, well, from 1 to 7, I am running appointments. And then every Monday and Thursday, I pretty much, work all day long. My wife and I wanted to start taking a marriage course. It was a 16-week commitment. It was like every Wednesday night, no more working during this time. And then it was like, my wife's like, you're not home for family dinner enough. And I was like, that's not okay. It's like, so, all right. So every Friday night, 4:30, I'm calling off. I'm going home and we're going to have family dinner and put the kids to bed. And like, I'm like fearful because it's like time is like shifting away. But then it was like Mondays, Tuesdays, and Thursdays all day. I'm dedicated from 8 a.m. to 10 p.m. every day, or those 3 days. And I'm seeing so much production come on those 3 days that like equaled what I used to do over the course of 6 days. Like I wasn't like trusting that I could have these things in my schedule. So it was like I was doing a little bit. And then while I was doing all of these things, I would then, randomly on a Saturday, we'd do a birthday party or something. And the whole time I'd be thinking about how I should be working as opposed to just being fully present in those moments. So now, as I'm starting to make some shifts, it's like Monday, Tuesdays, and Thursdays, my family knows that I am all in on what I'm doing. Wednesdays, I kind of have a late morning and do breakfast with the family, but I'm fully present during that Wednesday. Wednesday evenings, my wife and I do this marriage course. I'm fully present, not thinking about work. Friday nights, not thinking about work. And it's like, that's the hard part is that I found myself, trying to go all in. And then anytime that I put something into my schedule, I like felt guilty, like I was stealing from my business. But it's like what was really happening is I was stealing from my family. And it's like they've been the ones making the sacrifices for the last 3 years. And it took me a second to get to this point in my schedule. But like I'm noticing the production didn't change even a little bit. It's the exact same. But I'm doing it's the goal-based schedules where I kind of came to this whole conclusion was I'm still hitting the same number of appointments. I'll wake up my Monday, Tuesday, and Thursday. I'll have 10 to 14 appointments and just for those 3 days, and then I'll fit in a few Wednesday afternoon, and then I'll fill up my Friday morning, afternoon, and my Saturday evening, and I'm still hitting the exact same number of appointments, but I'm technically less time focused on work and more time, to family than I've had before, which is a wild place to be.
That's awesome. And then like you're way happier, your family's way happier. And I'm assuming when you're way happier, dude, that comes across in business too. Like when you're actually talking to your clients, you're freaking happy. You're living life. You're spending time with your family. You get to now go to work and serve them. It's not, I have to do this to get ahead. And I think that psychology matters a lot as you're actually selling stuff Sean would always talk about it. Whatever emotions you're feeling, leave them at the door. But when you're having good ass days and you're just living life, your clients know that. Your clients can sense it. They sense the good energy coming from you. And I think that is contagious and addictive. So that way, that's what they're getting, and they love it. And you probably have a lot of sales go up because you're just a happy and confident person.
Yeah, absolutely. So last couple things and we'll jump off of here. I do want to open up for a little Q&A. We won't do too much, but if anyone has questions, prepare them now, throw them in the chat, or we can unmute. But while people are preparing some questions right now, which can be anything IUL related or anything, about, life balance, whatever. Just for new agents who are getting started, who are maybe a little bit intimidated, like how would you recommend somebody, gets started as a new agent wanting to, focus on, slowly implementing IULs into their business and ramping up to potentially full-time IUL?
100%. So I'd be careful at the very beginning. If you're running final expense or mortgage protection, I used to get what's called annuity hungry. Every time I found a final expense person that had like 20, 50, 100K set aside, I completely forgot why I was there in the first place and just went straight into trying to sell them an annuity. So I'd be very careful. Just boom, going to hit them with IULs and lose focus of why you're there. So I say that with that caveat at the very beginning. To start learning more about it, there's two books. I have all my agents read these two books. Hands down, you got to read it before you actually get into this. Actually, three books. So the first one's Rich Dad Poor Dad. That's just for any agent altogether. You have to read Rich Dad Poor Dad. It's business 101. I used to hate reading before I got into that book, and now I read a lot. But anyway, so Rich Dad Poor Dad. In terms of the IUL side of things, the two books that I recommend, the first one is going to be called Money, Wealth, Life Insurance by Jake Thompson. It's just it's like a 60-page picture book. And we'll have more pictures. You can literally finish in a couple hours, but it's going to give you a very good overview about how money, life insurance, and wealth are all correlated. People like J.C. Penney, the Rockefellers. You guys probably see people like posting ads about, oh, J.C. Penney uses this, Walt Disney uses this, Ray Kroc uses this, Jim Harbaugh uses this. They're reading straight out of that book right there, the Money, Wealth, Life Insurance. And yeah, I'll type it in here in a second. Someone asked me that. So yeah, I'll type those books in here in a second. I'd read that book. And then the second book is called The Power of Zero by David McKnight. Very, very solid read about not just IU. The reason I love David McKnight is it's not just about IULs, but it's about how a lot of different retirement accounts work, how people can decrease their tax footprint in the future. You'll start learning stuff like when Social Security came out. The reason I'm explaining this, James, is when I first got into IULs, I just quoted a lot of the shit that was in the books. Kept it very simple. Someone had a question. Oh, well, here, and I just start using other people's word tracks to help build my confidence. You'll start learning about Social Security. You'll start learning about taxes. If people have too much money and they go to retire in Social Security and they haven't been taxed on it yet, well, your taxes, now your Social Security is also going to be taxed. You're making too much taxable income in retirement. So you're just learning a lot about the retirement space as a whole. So I would definitely pick up those two books. That'll give you a lot of confidence as you start talking to your clientele. Also, I used to just watch everyone on social media that posted it, and that would actually challenge me a lot. I'm like, is this true? Is that true? And then I have to call into all the insurance carriers. I probably called NLG like 5 times a day trying to figure out, hey, I have a client that wants to do this. I don't ask can they do, I ask how can you do that? So sometimes the sales agent, we got to realize they're just a person on the other, not the sales agent, but the rep on the other side. They're just the person. So when you challenge them, they're going to have to think of a solution for you. So that started helping figure out a bunch of different, is this possible? Is that possible? And it took me 4 or 5 months to really become an expert, and I'm still learning all the time. Let me post those in here.
Yeah, one thing as you're typing that, you said like, is that possible when you call the people? So a lot of these people who are posting on social media, they're specifically talking about, borrowing from yourself, infinite banking, be your own bank, all this stuff. Can you talk about like how a be your own bank policy isn't, it's technically a whole life. It's not an IUL. There's like a differences because like, I think people will sell an IUL as a be your own bank. And that also can kind of get you in trouble if you do that the wrong way.
Yep. Um, so you can be your own bank with an IUL whole life. There's a term called infinite banking. That is technically only done with a whole life policy. Infinite banking, 100% only whole life. And the big difference between the two, Jamie, is with an IUL, you could have 0% growth years. You're not always going to be making money on it. So a whole life policy, you're pretty much locked in at 4, 5, 6%, never more, never less. Locked in for the life of the policy. Where an IUL, you're not locked in. So it could be 0% years, it could be 15% years. So that's going to be one of the major differences that's going to separate the two. So if you ever see someone referring to infinite banking, is it the furthest thing from the truth? No, it's not the furthest thing from the truth in terms of an IUL. But if you ever talk to any experts, they're always going to say it's only done with a whole life policy. And a lot of it is going to be how the money is actually credited back into your cash value account.
And then the idea of like a client being able to like borrow and put it back in and borrow and put it back in, like there are stipulations on what can be borrowed from an IUL policy, correct?
Um, yes, so there are some stipulations that you can typically take out like up to like 90-ish for 80, 90, 95%, depending on the policy of what is sitting there in the cash value side of things. So if you have like 90K sitting in there, 100K sitting there, you can take out like 90K. Whether or not that's recommended is a whole different conversation. And when you take that out is a whole different conversation. If you're going to be taking that out very early on in the life cycle of the policy, by God, please pay it back. Please. Because if you're not making, if the index isn't going up, you just have a loan balance that's also eating at your policy. And it's not bad to have a loan balance eating at your policy, unless if you had $1 million in there, Jamie, you took out 90K, 100K, totally different conversation. But if you're liquidating a lot of it, you just want to be careful of being able to pay it back.
That makes sense. Okay. And anybody else have any questions? You guys, and you can unmute or you can type in the chat. Totally up to you guys. While we still have Dan here. Sounds like you taught a master class, Dan. Everyone's speechless and their sponges are full.
The title of the books, I'm typing a few of them out as we speak right now.
I'm not seeing them in the chat here. You're texting them to everyone?
Private message, and
Yeah.
then one person, I think, I'm assuming that it says DAV, I'm assuming it's David.
Okay.
So I sent that to Kristen as a private message. Hang tight, I'm going to send that to everyone. There we go. So
There we go.
I just put the books in there. There's a couple other books that I think are very, very good for like the sales side of things. Like Building a Story Brand by Donald Miller is it's kind of like a how to win friends and influence people. Just a modern day one. It's a really good solid read. So I just put if you go to or actually you can just go to this link. There's a link to a bunch of the books that I like reading in the IUL space and in the just business as a whole.
Love it, man. Well, awesome. We appreciate you, Dan. Thank you so much. This was definitely a fun one. I'm excited to continue to learn from you, man, and see how all this stuff continues to grow. So everybody, thank you so much. We've got live dials here for the rest of the night. Still early. It's still only 3 o'clock over there on the West Coast. So I'm sure there will be a bunch of people on here for the rest of the evening. But until then, everybody have an amazing night, and we will see you next time. Bye, guys.